I live already, so you can come on, okay? If you are free. Just drop by only lah, okay? Just drop. See you motivated to stream. Okay, mic test, mic test. Final mic test, final mic test. Okay, I think we are clear and good to go. Okay, we'll start in about 1-2 more minutes, okay? 1-2 more minutes. So it's 9 p.m. GMT plus 8. So welcome everyone. So if you're coming in, just hang on for 1-2 more minutes, okay? So over here is really mainly about stocks, options trading, live trading also. So I show you all my picks, my takes, and then my thought process. I also explain to you all why I choose to sell some positions on certain stocks, some of the options I choose to open position on or close, and not just in one direction, be it because the view strategy consists of the puts and the calls, so both direction. So today, same thing. There'll be 3 components, okay? So same thing. First, we will talk about the stock market in general, okay? Some of my thought processes, especially when it comes to stocks and the market overall. And then middle part, second part, we go to options. Okay, I think there's quite a bit of interest in options, so I tend to spend more time on it. And then lastly is a chit chat session. Okay, so the last 5-10 minutes we take it easy, take it casual, so more like a chit chat session. Okay, so 1 more minute, 1 more minute and we'll begin. Okay, by the way, the market opens in like what 30 more minutes, so just nice in within this 1 hour. If we have, we probably have time, and then we will try to also look at the market and then see if we can identify any opportunities for tonight. Okay, or rather, if you are in the US zone, it will be probably in the daytime. Over here is night time already, because Singapore here is almost like what 9 p.m. So I'll probably trade until like 4 a.m. that kind. By the way, if you're here in the previous stream, feel free to jump in and say hi. Okay. Hey, hi, Eagle Wise. Nice to meet you. Nice to meet you. Okay. Hey, nice to see you, Eagle Wise. Nice to see you. Thanks for dropping by. So if you're in the previous stream, feel free to say hello. Okay. Previously we were streaming. So the stream always begins Monday to Thursday, 9 p.m. GMT zone +8. Okay. Okay. So 10 more seconds, 10 to 15 more seconds, we will kickstart already. Okay. By the way, thanks everyone for dropping by. Thank you so much. Okay. So like I said, feel free to say hi, hello. If any questions, feel free to ask me. I will try my best to answer them. Okay, so let's begin. Okay, let's begin. Okay, so today I want to talk first part is like why I feel market nowadays it's harder for market to crash for a long period of time. So you know back then in the US market there this lost decade, right, between 2000 and 2009. You know, there's a lot of crashes, dot-com bubble, all these things, and the S&P annualized return was almost negative or sideways through the 10 years. That was called lost decade. Now, personally, okay, my take is that I don't think this will ever occur. Okay, don't quote me, I'm not financial advisor, okay? Remember, my name is Pigeon Investment. Would you take investment advice from a bird? No, right? If you take investment advice from a pigeon or bird, I think you need help, okay? So remember, some of the things I say are like bird language, you know. In Singapore, they call it jiao wei, okay? Okay, US just means talk crap now, okay? So remember, just a chit chat session, I give you my own opinion, and then you all see how it goes. Okay, so why nowadays personally my take is market can't crash for prolonged period anymore is because one key reason, okay, first key reason is the speed of news travel too fast. So in the past, news travel very slowly. People get news mainly for Telegram, or I don't even think of Telegram. It's what is it called? Some TV-gram, you know. They get some snippets of information online, and then back then internet wasn't that established, so they rely on newspaper. By the time the news reach them, it's very slow. Everything will have occurred. So imagine, let's say there's a huge sell down, and then by the time the news come to them, it's already quite late. There's heavy sell down, and because of that, people panic and continue to sell. So it contributes further to the extremely heavy sell down. So it will go all the way down. Okay. Yeah, I changed my screen first. It's not starting soon. It started that way. Sorry. Give me a moment. Okay. So that's why back then news travels slower. So when there's a sell down, by the time it reaches them, it's already sold. Then they sold down even heavier. And let's say when there's something positive, okay, there's some positive news, the market start to recover, it also takes a long time to recover. It's not like now, information, pew, 10 minutes, 5 minutes, 15 minutes, you get it, literally instant, you know. News reporter online, CNBC, Yahoo News, or whatever, you go online, news appears straight in your face, and you read, oh, this is what is happening. This is why market went up or down. So same thing in the past, news traveled so slow, so market took a very long time to recover. And even when the news reached them, they are like, hey, they are skeptical, you know, they wonder, hey, is this legit? Will the market truly recover? So it further contributes to the delay in recovery. So they need to find multiple news sources before it confirms and they get their conviction to start buying into the market. So that was what happened in the past. So that's why market had lost decade. You know, it can take years. If you look at the past trend, they can take 1 year, 2 years from bear to bull market again. Nowadays, no more. You look at all the previous sell down, you know, even tariff war, a few months only, what, 6-9 months, and even the recent, I think, quite a few months ago, the tech sell down, right? Everyone was afraid AI overspending cannot recover. It only lasts for what, a few months. Then after that, it shot back up again. So that's why the speed of news nowadays is so fast, literally instant. That's why my take is the lost decade unlikely to occur again. Rather, there's more volatility and swing. So personally, my take is if you're investing for the mid-term or the longer term, generally market will likely be elevated or at least stay constant. Because yeah, short term there will be swing volatility for sure, okay? But long term wise, it will definitely hold well. And it won't take like 10 years like last time, you know, to recover back again. I really doubt that will occur again anymore. Okay, so that's my take for the first scenario, first reason why I think market can no longer like stay low for extended period of time. No longer, okay? So it also give you an example, okay? Nowadays, okay, look at recent earnings, okay? Let's just use Microsoft. You know, last week reported earnings up 15% in one day. So, you know, before that, right, a couple of weeks or a few months ago, we all know Microsoft has been selling down, okay? It was depressed, okay? People were worried about, you know, they are not making money, their returns from AI is not there. But once they reported the news, they are doing well, you know, earnings beat expectation, bam, up 15% in one day. In fact, even before the market opened, it's already up. The market was traded pre-market. So pre-market already went up by 15%, or I think 13 or 14%. So you see the speed of news is so fast nowadays. I know back then they have this strategy, right? They say buy on rumors, sell on news. Now no longer works, you know. You can't either buy or sell on news anymore, because when the news happened, everything would have already been reflected in the stock price, because the speed of news is so fast. You buy or sell based on news, no longer work, okay? That's why nowadays when we do investing, we need to adapt and change our strategy. No longer back in the days, you know, the news say this, or enough news sources, then I do my buy or sell decision. It's too slow, way too slow. Like I said, Microsoft was a good example. You wait for them to release good result, good news, it really shot up already. By the time you buy, it's already up 10-15%. You know, you already miss the train, or so-called, you know, you're trying to catch, you're behind the curve. Unlike last time when they released the news or earnings, right, it takes a long time for people to receive it. It's not like, oh, immediately. In the past, I remember they sent what, booklet, newsletter to your house to show you the earnings report, all this, right? Let's be honest, that's how it works. So by the time people receive, they read, they analyze, they still have time to decide to buy the market, to buy the company or not, before the company shot up in price. So that's why nowadays, I just share with you how I adapted my strategy. So don't wait for news to happen, then you decide buy or sell. Too late already. What we need to do is to think one step ahead. So we go one step behind. So before the news arrive, we need to start making decision whether to buy or sell. So example, you look at what the data you have on hand present, okay, the present data that you have, all the information, and you foresee what is likely going to happen a couple of months later, okay. You cannot predict the future, but at least you can likely think that, months or years or even longer term down the road, what will likely happen. Example, years down the road, I am confident that tech, AI will be the future. Okay, I can't predict what happen next month, but likely, years down the road, any company that do AI tech will likely do well. So when at the time, like I said, Microsoft was down like what to 350, 360, 370. I was buying in aggressively because based on the data and information I had about Microsoft at that point of time, it was strong enough for me to buy into them. Plus, I foresee long run, Microsoft will likely do well and be part of the AI and tech future because they are still producing products that people use. They are not burning cash, people are still purchasing their products. So really at that point of time, I already foresee Microsoft was actually a bit undervalued. So you can see how all this past information and investing strategy needs to be updated. We need to adapt to recent times and change. That's why personally my take is because the speed of news now, information is so fast, literally instant. Okay, so we can no longer adapt the old strategy of buying and selling based on news. No longer work. Okay, so hopefully I share with you this part on how this, why I think market will stay unlikely, the lost decade, like stay depressed for like 10 years. I don't think it will ever occur. Okay, it will happen if there's a nuclear fallout. Okay, if you watch Fallout 1, 2, 3, 4, 5, right? Or if there's an alien attack, alien come out tentacles and then try to capture every one of you. Okay, maybe when that day happen, market will be depressed. Okay, but for a prolonged period, I don't think it will happen anymore. Now, I want to share with you second reason. Okay, my personal take on why market cannot be prolonged, depressed for a longer period. Okay, because my take is nowadays, to be honest, personally, okay, my own personal take is that 80% of the market value, okay, is honestly contributed by rich people, the elite people. Okay, I mean, it's tough to accept, but it is a reality, I feel. So just think logically, will the rich and elite people want the stock market to crash heavily until and depress for a long period of time and they keep losing money? No, definitely no. They will definitely want market to go down and up so there's volatility, they can make money off it, and 10-20% crash is okay, that kind, because market will recover quickly. But they definitely don't want prolonged period like what 50% crash like dot-com bubble for 10 years, that kind. So no, they won't let that happen. I'll give you one good example. Just a few years ago, when Trump started the tariff war, Donald Trump, he and his tariff war, the market kept falling downwards every day. It kept going lower and lower, 5%, 10%, 20%. Eventually, the low was like 30 or 40% low. Okay, but after that, he eventually softened his tone and changed his narrative. So I believe back then there were a lot of pressure from this so-called elites, rich businessmen that tell Donald Trump that, hey, you have to stop this, you can do this, but not too much. The market has sunk too much. So I believe Donald Trump took their advice, hear from them and decide to, hold back a bit on his words and become more neutral rather than so aggressive, the market keep crashing. And the moment he changed his stance, the market quickly recovered back like 10%. So that's why I don't even think it's a conspiracy theory. I think it's a reality that significant amount of the politics, the rules, the way things are constructed, especially the stock market. Rich people, elite people have a huge say in it and the way how they manage it. Okay, so with all these factors in totality, okay, plus what I said earlier, personally, I don't think stock market will ever go back to the lost decade, whereby stocks market are depressed for like 40-50% for 10 years. I don't think that will occur anymore. So that's why this sharing is to let you all know my take on why we need to adapt and change our strategy, and why I think investing is more important than ever. Okay, if you don't take advantage of the market which is open to you, I think you are really losing out. Okay, I mean, each to their own. Some people just dislike the market, don't believe in the market. They think stock market is a scam, bloody scam. Okay, I respect that. Okay, but you know, if you are someone who have done some research, read into the market, I'm sure you know the benefits of market. Especially some of you, I know you all have been in the stock market for a long period of time. You know, I can tell, you know, you all know that being in the market, time in the market is the most important thing. Not investing is simply losing out. Just based on inflation, you know, yearly increment, you know, increasing cost of living, you know that all these stock market which produce all these products, all this food, also be increasing their cost. So if you want to at least keep on par, on track with inflation, you need to invest. You need to invest in this company, be it they produce what daily products, medicine, what Johnson & Johnson, even McDonald's, Coca-Cola, all these things. If you are vested when there's inflation, they raise prices, their company will also earn more money, and eventually their stock price will also go up. And because you're invested in them, the money you have invested in them also grow up in value. So you can minimally at least, you know, be on par with inflation. So overall, my take is, if you don't invest in the market, I personally think that it is quite a big loss, personally. Okay, if you still don't believe in the market, I mean, it's all cool. Okay, I respect that. Okay, but if you think logically, great stocks, you know, you don't even have to invest in stocks. Even things like ETF, you know, like SPY 500, or global diversified index like IWDA, domicile in Ireland, or even any Vanguard fund, you know, BlackRock, iShares, that kind that has a global diversified fund, generally do well. Okay, even Warren Buffett himself, say that investing in the ETF is a no-brainer. Okay, he himself also recommend, you know, people to go and invest in a good diversified ETF like SPY 500. Okay, so let me just look at the comments and see any questions or not. By the way, any questions can feel free to ask. Okay, feel free to say hi. You know, if you are if you are here yesterday, feel free to also just say hello. I hope all of you are doing well. Okay, because I know that it's a Tuesday. Okay, we are 3 more days before the weekend. Okay, or at least 2 more days to go. Okay, Friday is kind of like a semi-weekend or a pre-weekend. So hang on tight. Okay, feel free to let us know. I hope work is not too tough for you. Okay, hang on tight. We are hitting Friday soon. And then Saturday, Sunday, hopefully you're on some rest or off. Okay, take some break and then enjoy yourself. Okay, and I do hope that you also have been making money. Okay, and any question about stocks, you know, options, feel free to let me know. Okay. Hey Jordan, nice to see you. Jordan Keller, hi. Thanks for saying hi. Good to see you. KMF, do you trade short-term option or you invest long-term via DCM? Okay, mix of both. So short-term options, right, I have also a variety. Okay, I do trade 1 day DTE, 1 day to expiry option, and also go for weekly, months, or even yearly options contract. So usually I use the wheel strategy in general. I sell options and I will stagger them. Okay, I did share the rationale behind last time in the past, but just to share is that by staggering your options, be it different strike price and a combination of duration, you actually manage your risk better. Okay, rather than all concentrated on 1 month, 2 months, day to expiry contract. When it expires, I mean, if it's not in your favor, not in your direction, you're in trouble. You have to take the loss, accept it, or you have to take the huge amount of assignment, okay, if you have the money, or you have to roll over and you have to hope that you get to recoup your money. So that's how I will stagger them. So yes, I do a combination. And yeah, I also trade, I also hold long-term shares like Apple, Microsoft, and Alphabet, and also ETF. So a combination. So mainly, options is more for income generation. I think you probably know, right? If you sell covered calls, you get premiums, and you sell put options, you get premiums. So I also have long-term stocks that I hold that I foresee will do well in the long run. Generally, the guideline is that for me personally, I only sell options. Sorry, I drink a bit of water. I only sell options on stocks I want to own and don't mind holding long term. Okay. Okay. Thanks everyone. Good to see you all, okay? Anything, feel free to let me know. Feel free to share your experience. Or if you have any thoughts about the stock market in terms of this time of the speed of news, how things have changed, just feel free to let us know. Okay, let me just sorry, give me a short while. A bit laggy on my computer. Okay, can. Don't know why this brokerage firm, or maybe my computer not very up to date. Okay, market will open in about 12 minutes. Okay, when market open, we will look at it and see any opportunities. Okay, so that's the first segment that I want to share with you all, my views on the stock today, the stock market, and my take on the investing strategy I adopt, be it for the stock itself, ETF, longer period of time, and my take on the stock market in general. Okay, so second component is we talk about options trading. Okay, options. Okay, let me switch screen a bit. Okay. Okay, I put my face below so you all can see the options below, because someone feedback that the comments are sometimes so fast sometimes, or words it blocks the options. So you can see on my first picture on top is all the options position I'm holding right now. Okay, so you can see a variety. You have Apple, Google, Nvidia, and SPY, that kind. Okay, like I said, I only sell options on stocks I want to own, and that's my personal take, because you don't want to, just because of high premiums on some random stock like NIO, GameStop. Yeah, the premium is very high, 100-150%, but the moment if the stock crash, you will be stuck with the stock. You don't want that situation to happen. Remember, the wheel strategy is to make money consistently over a long period of time. That's why I'm never greedy. I always try to position myself in a way that the stock I pick are generally of good qualities. I believe in it. I don't mind holding long term, and because I believe it will eventually recover and do well, so I can keep doing the wheel strategy on them, like sell cash cover put and then sell covered cost, and it keeps going on. Remember, by the way, this particular channel is not to get rich quick. We don't have get rich quick scheme here. It's always about making money consistently over a long period of time. Right now, I make about 5 to 6K USD per month on option selling. Okay, using this view strategy. Okay. Let me see. Okay. By the way, if I miss out any of your comment, feel free to highlight it. Okay, I saw your comment, Fatty. Okay, Fatty. Pre-market up about 8 to 9, then got pump up even more when market open, probably due to FOMO, then close 50%. Okay, you're probably referring to Microsoft, right? Yeah, so nowadays, because the speed of news is just so fast. No longer wait for news announce result, then you go and buy. I think it's too late already. It's way too late. Back in the days, you can do that because news takes time to arrive. But nowadays, bam, people lock in exactly on the time. People, even the news nowadays is almost live stream. The company announce sometime on video, do video share with you their result, and then they publish it literally online. People just get in and straight away can see the result. So really gone are the days whereby buy or sell based on news. I think it no longer works. So we have to think one step ahead by moving backwards, and we anticipate by telling us what are the data that we have on hand and the longer term perception we have, and then make a decision on that. Okay. Thanks for that comment, Fatty. Thanks for the comment. Okay. You see, that's why sometimes I see people's comment here, but I don't see it here. So if I miss your comment, feel free to highlight it, okay? So I can address it and we can have a discussion also. Okay, next up. Okay, so let me talk about options. So second part, previously the past few streams we talked about cash cover puts. We talked about option strategy. We talked about the wheel options, and I mainly covered on the cash cover put part, but I haven't talked about covered cost yet. So covered cost is also part of the option wheel strategy. So let me just quickly recap. Okay, I know some of you all seen my previous video, or some of you all very seasoned already. You all know what is covered call. Okay, be it you watch my short video or long form video, you all roughly know what is covered call. But let me just quickly recap so everyone has an idea, okay? Because some of you all may be newer to this option view strategy. So covered call, I'll give you an example. So example, you have 100 shares of Apple. Let's just use Apple as an example. So you currently hold 100 shares of Apple. You can sell a covered call on it by writing a contract and say that, hey, I will sell this Apple, 100 shares of Apple at a specific price. So example, let's just use an example. Apple is now, the stock market is costing $100 per share. Okay, stock market, Apple is now $100. You can choose to sell a contract that states that, I will set the strike price at $110. 100 shares of Apple, because I hold it, I set the strike price 110. And then, so if the stock market decided that in a couple of days, okay, Apple went up to 120 or 130, then you have to sell your Apple shares at 110, because there's a contract you have written. Okay, so it's an agreement, contract, options, agreement, basically it's the same thing, okay? So you have agreed to sell your Apple shares at 110, so you must fulfill it. So be Apple go to 200, you still have to sell at 110. But remember, you're not doing this for free. Okay, you're not doing this for free. Nothing is for free. Who will be so stupid to say that, oh, I have 100 Apple shares, I'm willing to sell it at 110, regardless of what price Apple will be in the future? Who's so stupid to give out an agreement without something in return, right? Okay, so that's why when you do a contract like that, the option, okay, you make an agreement. Okay, I do it 110 strike price. Okay, you get money for it. Okay, so example, you do that. Okay, and then people will pay maybe $200 for that contract. Like just example. Okay, so you receive $200 for making that contract. So let's say that contract, okay, this option you set at 1 month expiry. So within this 1 month, if Apple, stay at $100 or even drop to $90, the contract will expire worthless, okay? Because it never go above your strike price. So it will expire worthless, and then you get to keep your Apple shares, and you still get to keep the premiums, which is $200. Okay, so that's the whole concept, the gist of a covered cost. So in short, writing contracts or agreement based on the 100 shares per whatever company you have, and then you get money for it. Okay, so it can either get called away if it goes above the strike price, or nothing happens, it stays at that price or go below your strike price. Then you get to collect free premiums. Pretty attractive, right, this whole strategy. Okay, so let's just talk a little bit about more. Sorry, I drink a bit of water first. Yeah, so for those who just come here, today is mainly on covered cost, okay, because it's part of the component of a option view strategy. Okay, so you can see when you sell covered cost, covered must be covered. It seems quite safe, right? You think about it, you already hold an existing share, like 100 shares of Apple. So it's either it gets caught away or you just collect the premium. So there isn't really so-called much to lose, to be honest. So selling covered call in a way is actually pretty safe in the sense that there's no serious consequences because you hold the shares. Either I collect the premiums or I collect the premiums and it get caught away. And if you set a higher strike price than you originally purchased, right, you also earn from the capital appreciation. Example, all these Apple shares you bought in for like $90, okay? You sold it at a strike price of $120. Yeah, if Apple did reach $150, you have to sell it away, no choice. But the fact that you still sell at $120, you still earn $30 per share. So that's like what, a $3,000 profit. But of course, the downside is you cannot capture the higher gains because Apple went to $150, but your strike price is $120. So between $120 to $150, which is the extra $30, you have to give it up because your option contract, you agree strike price is $120, you have to sell at $120, regardless of how high Apple goes up. So that's the downside. But overall, you can't really see any significant dangers, right? Now, never ever, okay, not say never ever, okay, personally, okay, and I don't recommend also, never do naked calls. So you can see covered calls is when you have the underlying shares, okay? You hold the shares and then you sell calls on them. Naked calls is that you don't hold the shares, then you sell calls on them. This is what I call greedy, okay? Or very risk-taking. Because when you sell naked calls, your losses is unlimited, okay? Unlimited. Okay, because you don't hold the underlying shares. If the stock price go up by like what? 50%, okay? Go up by $500, you are in trouble, big trouble, okay? You don't even need 500, if the stock just go up by like $50 times 100 share, you'll be losing $5,000 because you don't hold the underlying share. You have to buy the shares from the open market, which has rise up too much in value already. So overall, naked calls must be very careful, okay? Remember, I don't do naked calls, okay? Not financial advice, but personally, I myself, and I will even tell people, right, don't do naked calls. Very risky. That's how you bust your account or destroy your whole entire financial system you have built. Okay, so naked calls, yeah, I mean it can give you potentially higher returns because you don't need to hold the underlying share, but it's way too risky. Okay, remember the option view strategy chases probability. You want probability and risk management. You want probability to be high in your favor, not taking all the risks. And remember, option view strategy, don't chase profit. You don't chase premiums. Okay, you chase probability first. Good probability of succeeding, then we talk about the premiums. Okay, not the other way around. You try to chase premium first, want a lot of cash, a lot of profit, right? That will be your downfall. That will be your downfall. Okay, so that's a quick summary of a naked call first. Okay, so next up, let's talk about how should we sell, no, naked call, sorry, overall about the covered call, okay, covered call concept. So how should we approach selling covered calls? So I give you an example. So we can sell at different delta, okay? The higher the delta, of course, the closer to your strike price. In general, okay, in general. So how to sell cover call is really depending on your strategy. So each individual is different. So example, if let's say I want to keep the stock as much as possible, okay? Let's say Apple again. My shares of Apple I want to keep because I believe long run they can continue to go up. Then your strike price you want to sell way further so that in hope that it doesn't get caught away. Example, okay, maybe you sell at 0.1 delta or whatever, okay? So example, Apple stock market price now $100. So you think that Apple may go up to 110, 120 in the next month, okay? Then you will definitely want to set Apple like example $130 for the next month in hope that Apple don't rise up too much in value, so you keep the share and keep the premium. Of course, the closer strike price you set to the current market price, the higher premiums you get. The further away, the lesser premiums you get. Makes sense, right? If you set an example 130, of course the premium will be lesser, maybe $50 only. Whereas you set it at 110, maybe the premium is $300. Okay, so it's really up to what is your strategy currently. Do you want to keep holding Apple to keep farming calls on it because you don't want your shares to get called away? Or you're bullish on it, you're scared that Apple will continue to go up, then you definitely want to sell a far away strike price so you can continue to hold Apple. But if you don't mind your Apple getting caught away, it's part of your cash flow management, then you want to sell as close as to the stock price, as close as to the market price as possible. Example, Apple is like $100 now. Okay, then maybe you want to sell $100 at 105 because number one, you don't mind your Apple shares getting caught away. Okay, that's number one. Number two, it gives you the most amount of premium. You don't mind because it's part of your cash flow strategy. So I can share with you that part of the option view strategy, the key essence is always cash flow management. So if you think that, I probably need a bit of cash flow next month because I have a lot of puts. I sold a lot of cash cover put and I need some cash to stand by. So all your calls can definitely, some of them you can stagger, some of them you can sell maybe further away strike price because you want to keep the stock, or some you don't mind getting caught away. You don't mind the shares or get sold away because you still earn. Maybe Apple you bought at $80. Strike price now, I set 100. I don't lose money. I still earn from capital gains. plus I get the fatty, juicy premiums. So next month I will have the money and then I can manage the puts position. So what kind of strike price to set for covered call is entirely really up to your strategy. So one way to decide is really your cash flow. Okay, cash flow is very important. And secondly, whether you want to hold the stock for the longer term. So that will influence whether what kind of strike price you want to set. So let me show you live example, okay? Because I have a few covered calls I can show you right now. Okay, so you see the first screen, I shuffle the whole thing in it. So you can see SPY put in the first few, and you see the number 4, or column number 5 actually, okay, column number 5, okay, I highlighted here. Okay, it's a SPY call. Can you see the profit or loss or not? Let me see. Okay, so just remember column number 5 is a SPY covered call, okay, SPY call, okay. Okay, can I just drag a bit to the left so you can see the negative $13,000, okay. So I explained to you a bit. So at that time I sold this SPY call, right? It's part of my longer term cash flow. So that's why I didn't mind selling the covered call quite close to the strike price. So at that point of time, I think SPR was like $600. So I sold the call at about 605. So at that point of time, my train of thought was that I don't mind this SPY being called away in 2026 December, which is end of this year. So my option view strategy is always staggered throughout. So I have contracts, both puts and calls, expiring every few weeks or monthly, 6 monthly, 1 year, or even 2 yearly, because I want to manage the risk. So at that point of time when I sold it, it was very close to the stock price at that point of time. Why? Because I will collect the most amount of premium. So you can see $30 per share. Okay, so at that point of time, I collected $3,000 USD when I sold that contract. Pretty attractive, right? 3K, 3K USD is quite a bit of money. But of course, now you can see the issue, right? SPY has went up to what? 750, 740 now. So you can see, because I agreed to sell this SPY at $605, even SPY now is 750, right? I have no choice but to agree to it and sell it at $605 because that's the agreement contract I written. So I have to adhere to it. So you can see at 605 compared to 750, that's like almost 150 difference, right? Or $140 difference. Okay, so there is like $15,000 amount of cap gains I would have if I held on to my stocks. So you see the issue here, when you sell all these calls, right? If you have a longer duration, you collect higher premiums, right? You will be at the mercy. Your downside is potentially you will miss out on the capital gain, which is here right now live here. Okay, you can see my first picture, fifth row, that I lost out on this capital appreciation, which is the 1500. Okay, so this is something you have to bear in mind when you sell covered call. The downside is you will miss out on the capital gain. Okay, so when you want to sell the call, you have to think through carefully first. What is your intent? Is it cash flow, or is it that you want to hold the stock for a longer period of time because you believe it will go up more, and then you want to keep farming and sell calls non-stop? So at that point of time, my take was cash flow. So I know that I wanted higher premiums at that point in time, and I know that end of this year, December, I need a lump sum to get ready for some of the puts that might be expiring. So you can see, even though it's $605, but when end of this year, when it expires, it gets sold for $605 per share. I will receive 100. It's always times 100. Option contract are dealt in 100. So I will receive 60,500 USD in my pocket as part of the cash flow to manage other options put that might be expiring. So this is my overall strategy for covered calls. So it really depends on you. Okay, so I hope I managed to share with you a live example here. Okay, yeah, you miss out on the premiums. You miss out on the capital gain quite a bit, about what, $15,000. Okay, you have to accept it. But it could have went either way, you know, maybe SPY didn't go up to 750. Who knows, SPY today is like $605. Then I will have earned it, right? I mean, it will be beneficial for me because I collected so much premium without losing my shares. Or maybe SPY is $600 today. End of the year is also $600, and I get to collect the 3,000 premiums for free, and I still hold my shares. So there's always both sides of a coin, you know. How you manage it is really what is your current priority and your strategy. So from there you can decide whether are you going for more premiums, cash flow management, or do you want to hold it for potential capital gains. Okay, so that's what I want to share with you on the covered calls, how to sell. So whether you want to sell at 0.2, 0.3, 0.4 delta, really up to you. You know, what's the strike price you want to set? Up to you. Okay. Okay, so lastly, I just want, okay, there's two more components, but because of time constraint, I cannot talk too much, okay, about the rolling part and what is the exact price usually I will sell. So I just talk about one part, okay, the next part maybe another time, because cover cost actually has a whole chapter of strategy and my personal experience with that. So we can talk more another time. But let me just share one more component of covered call, okay? Now, one more thing for covered call is I will never sell covered call the strike price below the price I purchased of the stock. So example, I'll give you an example, okay? Apple, let's say I bought it at $100, okay, $100. I will never sell covered calls on them with a strike price lower than $100. Example, $90, $80, no way. Yes, if you sell a strike price that is lower than the current stock price, okay, let's say it's $100, okay, sell at 90, 80, yes, you will get higher premiums. Especially, when you buy at $100, you choose to sell at $90, maybe you want higher premiums, okay? There is a very good possibility that your shares get caught away at $80 or $90, okay? The chance is very high. Yes, the premium you get will likely be higher, but usually it's not enough to cover the potential loss. This is what I call greedy, okay, greed. Okay, you are trying to bet that Apple will stay depressed and go below the strike price you put out because you want more premiums. When you set a higher strike price at 110, 120, you will get lesser premium. It's like that. So remember, the option view strategy is to consistently make money. Consistently, okay, I repeat. We want to consistently make money throughout up and down times. So don't be greedy. Don't be greedy. So my rule for selling covered call, never ever will I, okay, sell strike price below what I paid for the stocks. No way, okay? So this way I can consistently make sure that I'm profitable, I manage my risk reward ratio, and I'm never greedy. Imagine, okay, you bought Apple, okay, $100, then you sell a strike price at $80. The premium you collect, it's not even even enough to cover that $20 difference loss usually. So imagine you sell at $80 strike price, it gets caught away. Yeah, maybe you get, I don't know, maybe you get a couple of $100 or maybe $1,000 premium, okay? But remember, you bought the share for $100, you sold at $80. That's $20 loss per share. 20 times 100 share is $2,000. Even you collect $1,000 premium, you still lost 1K because of the capital difference, the stock price difference. So always remember, when you do option view strategy, must look at the total profit and loss. Okay, take into consideration the capital you spend to purchase the stock, okay, and the strike price you sell. Not just on premiums, okay. One of the key reasons why people fail the option view strategy is not because they don't understand. It's because they only concentrate on premiums. They refuse to acknowledge the entire profit loss in totality. The prices, the strike price. They refuse to acknowledge it. Like people who do GameStop or NIO, NEO, all these things. Yeah, they make thousands of dollars in premiums, but the stock price dropped like $30 or even $50. And they never take into factor those huge losses that they have made. Okay, so that's the main part I want to share about covered costs. Okay, hopefully it helps you. Okay. Okay, so there's another component about covered calls, such as rolling all these things, like why I don't roll all these things, but we'll probably keep it for another session. Like I said, Monday to Thursday, our stream, so 9 p.m. GMT, so 1 hour. So I mean, the next few days we can talk more about covered calls, all these things. So there's a lot of strategy nuances in the option wheel strategy, not just on the cash cover put side, but also on the covered call side. So we will go more in depth as we go along, okay? So that's all I will cover for today on covered calls. So hopefully it gives you some explanation and thoughts, all these things. If you miss out certain parts or not clear, you can always rewatch, okay? I will always publish the VOD, okay? I mean, it will be re-uploaded, and then you can come to this segment to think through. Okay, so let's just look at some questions and any comments. As usual, any questions or comments, feel free to just highlight it. I will do my best to answer them, okay? Or if you have any other thoughts on selling covered calls options, can also let me know. Happy to learn from you as well. Okay, wait. Hey, hi everyone, good to see you. Okay, may I ask how much capital do you use to generate 5 to 6K options? Okay, so personally, I think it really depends on individual. Okay, if the stock that you sell options on, like example Nvidia has higher premiums, and you like Nvidia, or like you like some of the tech companies that give higher premium, you will definitely require lesser capital. Okay, but personally I now have about a 1 million portfolio, 1M, okay, about 1 million portfolio. So of course not all are in the options, but this 1 million portfolio give me some cushions in managing some of the options. Like I said, if you have higher, bigger portfolio, right, you are more confident to take on more risk. So personally, I don't have an exact figure for you on how much you need to generate 5 to 6K USD. It really depends on the stock that you choose to sell options on. So example, let's just talk real life now. Okay, example, I give you an example now. I can answer this question. I give you an example right now. Okay, so not sure you all can see my screen. Okay, let's just go to Nvidia. Okay, Nvidia is one classic example. Okay, because Nvidia premiums are high now. Okay, so let's just use Nvidia. Yeah, I want to make sure you all can see. Give me a while. Okay. Sorry, give me a while. Give me a while. Okay, I shift my screen a bit so you all can see. Okay, can see. Okay, looks clear now. Looks clear now. Okay, so just to share, okay, I mean, because Nvidia now we are looking at cash cover put now. Let's just use cash cover put as an example. Okay, the second screen. You all look at the second screen. Okay. So like I said, when the stock price right itself is going up, right, the premiums for the option when you sell cash cover put will come down. So you can see all the red numbers here. But despite the red numbers, it's fine, because Nvidia options IV is very high. So you look at this column called IV, the percentage here, IV. You can see my mouse cursor, okay? IV stands for implied volatility. So the higher the IV, the higher your premiums. So Nvidia is one of those few company that's very high IV, 44%. It's quite high, okay? Generally, the safer one, or so-called the more stable ones, are like 15 to 20%. So 44% is quite high. But let me just use Nvidia as an example, okay? Not telling you all to sell options on Nvidia, please. Nvidia is a high risk stock, so you must bear in mind, okay? But let me just use this as an example. So example, let's just say, okay, let's just take at 0. Okay, simple example, let's just say 0.3 delta, okay? So you can see Nvidia put, I highlighted in red, okay? Strike price $200, and you will receive premium of about $700. Okay, $700. So let's say example, I give you an example, okay? When you sell one option, okay, you strike price 200, you need to prepare $20,000 USD, okay? 20K USD in case you get assignment. But the moment you sell it, you get $7.20 per share. That means $720. So for every contract you sell and a strike price of $200, okay, you will receive $720 premium for this 45 days contract. Okay, I wrote here 45 days here. Okay. So how do we get 5 to 6K or even 7K times 10? No? Okay, so you see $20,000 standby per contract to make $720. Okay, so to make 7K, I need 10 times of it. So I will need $200,000. Okay, if I sell 10 contracts, I repeat, 10 contracts with strike price of $200, premium of $7.15 per share, I'll receive 7K USD. Okay, $7,000 USD, and I have to get ready 200K USD to get assignment. If for whatever reason, maybe Nvidia really fall down a lot, I have to take assignment. So you can see how much you need to generate 5 to 6K USD or even 7K USD really depends on the option you want to sell on which particular company. So Nvidia, let's say, is a bit more risky, but you don't mind holding, yeah, then technically, okay, 200K is enough for you to make 7K USD, okay, every 45 days. Okay, I mean plus minus, okay, maybe you go to 38 days, it's maybe like 6K USD, okay. So every 45 days, technically, okay, you can make about 7,000 USD for 200K USD capital. So I hope I managed to answer your question, okay. So personally, okay, I mean I could have made more definitely, okay. I mean with a portfolio of 1 million, definitely I have more flexibility to sell even more contract. You see, with just 200K here, technically this example, with just 200K capital, I can make 7K USD already. So imagine with 1 million times 5, So technically I can make 35K USD if I all in Nvidia options only. But the question is, will I do that? Of course, no. So remember the trick on when it comes to option selling, particularly this option view strategy that I always use, is cannot be greedy. Okay, yeah, Nvidia, we all know the premium very high, very attractive. Wow, 20K I can make $730 USD, so attractive, right? And $200,000 capital I can make 7K USD every 45 days. That is a lot of money, a lot of money. Okay. But you definitely don't want to sell all on Nvidia. You want to stagger over different companies you like, be it Alphabet, Microsoft. Like personally, I show you, right? You see my first screen on top. I have different put options and covered calls on different stocks, like Apple, Microsoft, even SPY 500. Okay, I'll give you an example now. SPY. Okay, let's just go SPY. Okay, so I can demonstrate to your real life. Okay, I'll give you one example. SPY. Okay. So you can see the difference between SPY and Nvidia. So same thing, okay, let's go for 45 days contract. Let's look at 45 days duration. Okay, 45 days, okay. So just now we saw $700 profit, okay, about $700, $200 strike price, Nvidia will give you about $700 per month. Now you look at SPY 500, okay. Strike price at $740, but the premium is only $7. Whereby Nvidia, $200 strike price only, the premium is what, $720. So the difference lies in the IV, implied volatility. Okay, you see my mouse cursor there. Earlier you see Nvidia implied volatility is like 44%. SPY is only 15%. Okay, so you can see over here for SPY, you need $74,000, okay, 74K to stand by for assignment just to earn $700 worth of premium for SPY put. So you can see implied volatility plays such a huge part in the premiums you get. Nvidia, 20K I get 700 USD. SPY I need 74K just to get $700. So you see the difference. So there's a reason IV is high. There is a reason. Because of volatility. SPY we all know is a very stable stock. It's unlikely to fluctuate very much. But NVIDIA, I can tell you, NVIDIA, it can go up 10% in one day, drop 10% in one day. You have to prepare anytime to take assignment or even at the loss. Right? But SPY is more stable. You are more likely to come out ahead, less likely to get assignment if you sell at a far away strike price. So these are risk-reward ratio you have to accept when you're doing option view strategy. Drink some water, sorry, give me water. Thirsty. This is why I want to emphasize when you sell options, as particularly this option view strategy, really cannot be greedy. Yes, if I do all in NVIDIA, I'll make like what, 35,000 USD per month. But I'm not going for that. Remember, I want to make money consistently through all times. Bear market, bull market, sideways market, I want to try to make money consistently. This is why I stagger all my put options, covered call on the first screen. Okay, you see my first screen on top. I sell on different companies. Okay, Alphabet, Microsoft, their premium may be lesser compared to NVIDIA. I accept it because I want to manage my risk level. Okay, remember, never put all your eggs in one basket. You don't bet everything into one. Because when you choose to do that, right, you are just being greedy, to be honest, okay? No matter how confident you are, okay, how much research you have done about this company, be it on Reddit, forum, books, or Grindr, Tinder, that kind, how much research you have done, okay, it doesn't matter. It's just your refusal to acknowledge its downside. The day when NVIDIA crashed, it destroys your entire financial system you have built for yourself. So remember, option view strategy, we do not do that, okay? We want to make money consistently. One of the key reasons, thanks for highlighting by the way, one of the key reasons people fail option view strategy is because of all in into one particular company for options because they want juicy premium. Okay, so hopefully I give a bit more explanation on that, on how much capital you need to generate, like 5,000, 6,000, 7,000 USD per month. It really depends on your risk management, what kind of company you want to sell on. So you can see, right, you don't really need a lot of money to even generate like 7K USD. The earlier example I used technically, okay, NVIDIA, 200K, stand by, I can get 7K USD per month. That is a lot of money. 7K USD is a lot of money, okay, with just 200K USD capital. So really just bear in mind that it really depends on your risk management, the company you want to sell on. Okay, so that's all. I won't repeat further. Hopefully that gives you some insight. And as for, because some of you also asked me why I choose to sell on different company, why not all in on one particular company that has higher premiums. Okay, I talked quite long already. Okay, we try to just go for about 10 more minutes, then we will end the session. Okay, stock market open, let's go inside and identify some potential opportunities. Okay, so let's just look at the second screen and we see what's the result. Wow! Palantir up 20%. This is what I tell you, stock market, especially the tech sector, can be quite volatile, okay? One day up 20%, I think, okay, I'm not an investor of Palantir, so probably I think they have good earnings result, okay? It was reported probably they get good earnings, okay? I don't follow Palantir because I'm not vested in it. So probably there must be some good result, that's why it's up 20%. Okay, Intel also not too bad, up 6%. I think someone asked me before whether Intel still got opportunity or not. Personally, I think that it has not huge potential. There is potential in Intel, but you might have to take a longer term perspective. And it's a high risk, high return stock. Intel could sink, could just go back to $30 or even $20. Okay, but if you are willing to, if you have a huge portfolio, like I say, let's say you have 100K, okay, there's no problem in taking $1,000 to buy some Intel. 1% of your portfolio you put in Intel, I think it's quite comfortable. Well, what's there to lose, right? Okay, NVIDIA now up, okay, good, 1.3%, okay. Okay, SPY also up on trend. Okay, my take on SPY is that in the mid and long term, it should hold well, or at least trend up a bit. Okay, my personal take, Okay, so I always wanted to buy Apple, but Apple is now still at 305. So To be honest, I might initiate a few positions in Apple soon. I probably want to buy like 10 to 20 shares, okay, as part of my diversification strategy. Because I have top 3 holdings. My top 3 holdings are Apple, Microsoft, and Alphabet, my 3 favorite companies. I'm trying to bring all these 3 companies to about 33% each. Okay, now I'm a bit overweight on Alphabet, okay, Google. I think now it's like about 41 or 42%. While the others is like about 20 plus to 30%. So I'm trying to bring all these 3 companies to 33% each. And you know, Apple recently had a sell down, right, because of their weaker forward guidance. I'm hoping it will go to 280, 290, but if not, I will still get it at about $300, even 305. I will still build some position in it. Okay, so I don't think there's any much position I can sell today. Okay, there isn't any companies I want to sell puts today. Okay, so having said that, I just want to quickly add one point is that you don't always have to trade every day. Okay, so one of the mistakes people make when it comes to option view strategy is they feel that every day they need to sell. Every day they need to sell some calls or puts. If not, they are not doing something to make money. That's a huge mistake, okay, huge mistake. Option view strategy always require opportunities as well. If there's no opportunity, then just call it a day, it's okay. Or maybe wait a few hours later into the market, then you decide whether to make any position. Remember, not making position is sometimes the best strategy, okay? Not doing anything is sometimes the best strategy. Okay, so let's just look at any potential opportunity for me to close any position. Okay, so as much as I don't see any opportunity right now to sell puts, but let me see any chance for me to close my positions or not. Okay, like I said before, I close when it's 50% profit margin. Okay. Okay, so I briefly scanned through. Don't have anything that's 50%. The one that is closer enough, let me show you. Okay, yeah, don't have anyone that is 50%. Yeah, I mean the closest one is 34%, my SPY put. If you see the second column, okay, second column put, SPY put is now at 34% profit. Okay, about 1600, about there, 40% now. Okay, so like I said, I always close my position when it's closer to 50% profit because I want to have a good balance of risk and reward ratio, and also because I don't want to hold the remaining contract for the remaining 50% premiums. I already secure 50% premiums already. Why do I want to wait for 1 or 2 more years to get the remaining 50% profit? Okay, it doesn't make sense. I know I said it before in the past few streams sometimes. Okay, sometimes I'll repeat myself. Okay, pardon me because I know some of you all may be new or maybe new viewers. Okay, so or maybe ask me some similar question along this line. Okay, so remember my target profit is always 50%. So we see how I will be watching the market for the next few hours later. If it hits 50%, I will close the position. And I assure you, I will always update you all, okay? So every day in the stream, Monday to Thursday, I will always update you all on the new position I built and the position I've closed. Okay, it's always transparent, always honest and upfront, okay? So if you have other puts you're holding, you also can share with me. Let me know your strategy, what percentage you're close. I'm also keen to hear your thought processes. Because a lot of people, sometimes they just share, oh, I open, I close, I get this profit. They never really explain their thought processes, why they choose to close or open. So this is quite important. So that's why I choose to stream so I can share with you all. And you all also please feel free to share with me so I can know your thoughts behind the rationale and I can learn from you as well. Okay. Okay. So that's all for the options component today. So we will keep it short. Okay, so it's 10:05. Okay, 10:02 already. Okay. Sorry, we try to keep the stream within 1 hour. Okay. So last part, right? So the last part we will just talk about 5 to 10 minutes, a casual chit chat session. Okay. Don't keep looking at the stock. So stressed. Okay. Okay. So now I put my head on top. Okay, so you all can see my face. Okay, so the last component usually is just a chit chat session. Okay, y'all can stay or don't stay, it's up to you. Okay, not so much on the options. Okay, more on a casual finance topic. Okay, so the last part we take it easy. So today I just want to talk about why the biggest myth. Okay, really the biggest myth is that people feel that dividends are the safest stock. Okay, dividend companies are the safest stock. I think it's a uber legend myth. So let's talk about it. Okay, so first thing, dividend is not free money. Not free money. Some people has this perception. Dividend is free money. Oh, I buy this stock every quarter or semi-annually, I get free money. Not true. Absolutely not true. Dividend is not free money. Okay, please remember, dividend is simply not free money. Dividends are actually paid from the company assets. So usually, okay, let's say this company is valued at whatever lah, maybe let's just use Singapore example. Okay, this company valued at $2. Okay, $2. Okay, I pay a dividend of 10 cents per share. Okay, maybe you own like 10,000 shares or whatever. The next day when they release dividend, the company value, the stock price, will automatically drop by 10 cents. So from $2 become $1.90. So that's why dividends are not free money. It's taken from the company asset itself to pay you. Okay, so money don't drop from the sky. Okay, it comes from the company itself, the assets. So some people got this perception, dividend is free money. So not true. Okay, remember, it will be reflected on the stock price the day it pays you the dividend. Okay, now number two, always remember, dividend stock still can crash. Okay, once again, let's look at Singapore example. Okay, Singapore, recently we look at this Maple Tree family, especially Maple Tree Lock, Maple Tree Commercial Trust, all these things. It has crashed a lot by what, 20-30%, and has never recovered for a long period of time. So some people think that, oh, dividend stock very stable, can only go up or at least maintain. Not true. Okay, look at Maple Tree, quite a branded, okay, well established, so-called blue chip REIT in Singapore, has sunk a lot. Okay, it has dropped what, 20-30 or even 40%, from what, $2 plus to what, 130, 120. Okay, it's a huge drop, and it has never recovered. Okay, so remember, dividend stock are not 100% safe. Okay, and their return maybe it's not 4 to 5% only. It's not a lot. So don't have this perception that, wow, dividend stock sure win, wow, must buy, sure stable. Okay, not true. Always remember, don't just look at dividend, look at the company. Okay, I mean, I get it for newbies or newcomers when they first started. Okay, be in the US market, okay, or Singapore market. It doesn't matter where you are. I know the first few pick is usually dividend stock because they are so-called generally more stable. I get it. But as you go, as you are invested in the market for a longer period of time, you should quickly realize the downfall, the pitfalls of dividend stocks. Like 4 to 5% not going to cut it in this hyperinflationary environment. And dividend stock can crash. Just remember that. You think logically, an ETF like SPY 500 give me like 9 to 10% per year. Why do I want to touch the dividend stock? Be it like what, Coca-Cola, McDonald's, or REITs in Singapore, what, Capital Mall, Fraser, Centrepoint Trust, they only yield like what, 3 to 5% per year. REITs is just one sector. You pick a few companies, but SPY 500 is the top 500 US company. You are way diversified, probably safe, higher margin of safety. Okay, as compared to the few REITs you choose all in that particular sector. So remember, dividend is not a sure win strategy, okay, and it's not a formidable, unbeatable company. It can crash. So that's why today just want to highlight about this part, because some people ask me, hey, Pigeon bro, should I start with dividend stocks or not? So personally, not financial advice. Don't take advice from a birdman like me, okay? You are starting, yes, you can kickstart, to get your feet wet. You want to gain entry into the US market or any stock market in the world. You want to learn a bit, you want to get used to it. Yeah, dividend stock could be a good choice because most dividend companies are generally good companies, right? That's why they can afford to pay you dividends. And always pick quality business. Don't be greedy, pick those companies that pay you high dividend, but the underlying business is very weak, it's rotting. They are constantly borrowing money to pay you dividend. Something is wrong. Okay, pick quality ones like McDonald's, Pepsi, P&G, Procter and Gamble, if I'm not wrong. I mean, I'm not very well versed in dividend stocks. I stopped touching them. In Singapore, like DBS Bank, okay, Fraser, that kind of more branding, okay, or Coca-Cola, that kind. So yes, for a start, yeah, you can pick those branded good ones. But long run, do think about the pitfalls of dividend stocks, and then you may want to branch into other sectors or other strategy, or even like an ETF I mentioned. Okay, let's just see. Okay, if you have any questions, can let me know. And then we will be ending stream soon. Okay, it's about 10:08 already. Okay, so it's 1 hour plus already, so we are stopping soon. Like I said, I missed out any comments, please feel free to highlight again. I hope those who were previously here, in the previous stream, I mean those who were in my previous stream, feel free to say hello. Okay, hopefully you have time to drop by. If no time, I hope everyone is doing well, doing fine with life. I know work is busy, sometimes no time, very busy, but I just hope that work is not too stressful for you, and I hope that you have been making money from the stock market to have a better quality of life. Okay, that's all. I think I won't hold everyone back. Okay, so today's stream will stop here. Same thing, tomorrow I will be back. Okay, Monday to Thursday, same timing. I'll be here tomorrow, 9 p.m. time zone GMT+8. I see you all tomorrow. And if you miss out certain parts of my stream or whatever, don't worry, all my stream will always be published onto my channel, the VOD, video on demand, so you all can rewatch certain parts if it helps you. Okay, so that's all. I don't hold you all back. Thank you so much for being here. And hey, Yav71, hello. Hey, good to see you, Yav71. I thought you are not dropping by today. Thank you so much for coming out. I was really hoping to see you. Okay, I guess work must have held you up, or maybe you were busy. Hey, thank you so much, Yav71, for dropping by. Really happy to see you. Okay, I was thinking, hey, where is Yav71? Is he busy today or not? Or is he busy counting the money he made from Palantir? Because Palantir up 21% today, So I maybe, Yav making too much money now, busy enjoying his life now. Okay, so I will end the stream here. Hey, good to see you, Yav. Hope you are doing well, have your great dinner. And then to everyone, thank you so much for dropping by, chit-chatting and saying hello. Okay, you also can send me messages or comment, be it you are from TikTok, Instagram, okay, all these things, feel free to say hello. Okay, so that's all for the stream. Okay, thank you so much for dropping by. I see you all tomorrow, 9 p.m. GMT+8. See you all, bye bye, thank you, bye bye.